In this video, we're going to talk about return on investment, or ROI, which is one way in which managers are evaluated. So return on investment, it is calculated by taking net operating income and dividing it by average operating assets. So net operating income, this will refer to EBIT or EBIT, which is earnings before interest and taxes. So that is another way that you might see this pop up. So earnings before interest and taxes. And your average operating assets, that includes things like your cash, your accounts receivable, plant and equipment, and any other productive assets. So as an example, let's see what this company's or division's net return on investment is. Because we can see here they give us net operating income, average operating assets, sales, and operating expenses. Well, if we know what the calculation is for ROI, we can pull from this list of information what we need. What's our net operating income? Well, the net operating income here we know is $50,000. And we're going to divide this by our average operating assets of $230,000. So let's find what our return on investment is here. 50,000 divided by 230,000, that is about 21.7%. So our ROI here is 21.7%. So essentially, this looks at how effectively these operating assets are being used to actually generate income. So the higher the ROI, the better. So the better we're using those operating assets to actually generate an income. So here we have 21.7% as this division or company's ROI. So there are some criticisms behind the ROI calculation and using it as a way to evaluate employees. Managers evaluated on ROI will sometimes maybe reject profitable investment opportunities because although the overall project is profitable, it might make the division's ROI slip a little bit, and if their compensation is tied to their performance from one year to the next, that manager might decide to reject a profitable project. And oftentimes, managers will inherit many committed costs over which they have no control, which if they are inheriting committed costs, that's going to impact their ROI without them even having a say in the matter. So then it's a little bit difficult if they're being evaluated on ROI, and if ROI includes net operating income, which would be smaller if they have these committed costs that they're now responsible for. And also, in the absence of a balanced scorecard, management might not know what to do to increase their return on investment. So let's look at another example here. So we have Redmond Awnings, a division of Wrap-Up Corp. Corp has a net operating income of $60,000 and average operating assets of $300,000. The required rate of return for the company is 15%. So that's the minimum ROI that the company is looking for. What is the division's ROI? Okay, so let's do this calculation. We know ROI is net operating income, which in this case is $60,000, divided by average operating assets, which we know is $300,000. Let's see what we get when we take $60,000 and divide it by $300,000. That gives us 20%. So currently, as it stands, this this division's ROI is 20%. So if the manager of this division is being evaluated based on ROI, they're currently sitting at 20%, which at least is above the 15% minimum that we're looking for. All right, so now let's expand this discussion. Let's say we have all the same information. So Redmond Awnings has net operating income of $60,000 and average operating assets of $300,000. If the manager of the division is evaluated based on ROI, will she want to make an investment of $100,000 that would generate additional net operating income of $18,000 per year? So we're asking a couple questions here. So it says if the manager of the division is evaluated based on ROI. So where's the ROI currently sitting? At 20%. So we want to know, will the manager of this division want to take on this project with the current ROI at 20% if that project is going to lead to an increase in net operating income for the division of $18,000 per year. To answer this question, we first need to see what would the new ROI be if we were to invest that $100,000 to generate that additional net operating income of $18,000. So what would be the new ROI? Well, there's a couple things we would need to find first. What would be our new net operating income? Well, currently it's at 60, but we said it would increase by 18,000. So our new net operating income after the investment would, based on our estimates, be 78. And what would be the new operating assets total? Well, remember, it was currently sitting at 300, but if we invest $100,000 more, then we're investing in more assets there. So our operating assets would go up to $400,000. So what would be the new ROI post-investment? Well, we know ROI is our net operating income divided by average operating assets. So let's see. We have 78,000 divided by 400,000. Do 78 divided by 400. So that's 19.5%. So let's ask that question again. So if the current ROI for the division is sitting at 20%, and if this manager of Redmond Awnings, if the manager is being evaluated on the basis of ROI, will she want to invest in a project that's going to cause her division to have an ROI go from 20% down to 19.5%? Well, the answer to that would be no. If she's being evaluated based on ROI, because just think from her perspective. Because if she gets pulled into her evaluation at the end of the year, they're going to ask her, okay, we see here that your ROI went down from 20 to 19.5%. Why is that? Or even if it's just arbitrary compensation. So if bonuses are arbitrarily calculated based on performance measures, if the system sees that her ROI went from 20 to 19.5, that might impact bonuses and stuff like that. But not necessarily, but it depends on the company and how the setup is. But if this manager is being evaluated based on ROI and there's a project here that will cause her division's ROI to drop, she wouldn't necessarily, or the assumption is that she wouldn't necessarily be motivated to invest in this project because of that decrease in ROI of 0.5%. Now, it's not to say that the project itself isn't profitable. We'll look at that in a second, but the ROI of the division itself would drop. So because of how she's being evaluated, chances are she wouldn't take on this project because of that dip that we would see in ROI. All right. Now let's take a look at the same situation here, but let's look at it from a different perspective. The company's required rate of return is 15%. Would the company, again, not the division manager, would the company want the manager of Redmond Awnings to make an investment of $100,000 that would generate additional net operating income of $18,000 per year? Well, we found the impact of the division ROI, or we found the impact that the investment would have on the division's ROI. But what's the ROI of the investment? Well, we can find that. What's the net operating income we think the project would generate? $18,000. Divide that by the $100,000 of average operating assets that we would be investing in. 18,000 divided by 100,000, that's 18%. So the project would be profitable, first of all, and its ROI would be 18%, which is 3% more than the minimum. The company wants investments to generate a return of at least 15%. This project generates a return of 18%. So from the overall company's perspective, would they want her to invest in this project? The answer is yes. And why is the answer yes? Because 18% is above the minimum required rate of return. But the 18% is just the project itself. So the profitability of that investment. But by investing in that project, the overall division's ROI would dip ever so slightly, only by 0.5%. So depending on who you talk to, the project might be accepted or denied. So this is why how managers are evaluated and rewarded is important, because it can have an impact on investments being made or not being made. And to finish off our discussion of ROI, let's briefly look at the different ways in which it can be calculated and really where it comes from. So we talked about ROI being defined as net operating income divided by your average operating assets. But ROI is actually made up of this whole calculation here. It's actually made up of two other things. ROI is also defined as margin times turnover. So how do I find margin and turnover? Okay, so well, let's look at that. So margin, to find margin, you're going to take net operating income and divide that by sales. To find turnover, we're going to take sales and divide that by average operating assets. So it's these two together that really make up ROI. So let's put those two next to one another. So we said net operating income divided by sales, that's margin. And let's keep this in two brackets. And we said margin times turnover is ROI. And turnover is sales divided by average operating assets. We said this is turnover. We can see just algebraically that when you multiply two things together, we have the sales diagonal from one another. So they cross cancel, they cancel each other out. So that leaves us with the net operating income at the top and average operating assets at the bottom. And this overall here is ROI. Okay, so depending on the problem, what information is given, you might be able to use this one, or sometimes you will use margin and turnover to find ROI.